live from downtown New York City, home of Wall Street. But guess what? You don't need those basic Wall Street traditional investments. In fact, I'm here to show you a better way. If you're trading stocks and you're not trading options, man, you are literally missing the boat. Only two strategies you need to know. Sell a put. What you're doing is taking in cash, you get paid right away, and you're committing to buy a stock that you like anyway if it goes on sale. If it doesn't go down in price, you don't buy the stock. Either way, you keep the cash. Why would you buy stock when you can trade puts instead? You're crazy. And if and when you get assigned those shares, if the stock goes down and you buy those shares, what do? You turn it right around and sell a covered call against it and make money again. And guess what? When you sell options, you get paid right away. Man, that's so much better than trading stock. Okay, you stock traders out there, you buy some stock, you're hoping and praying it goes up, it goes up, it goes down, and you're all excited. But guess what? Can you spend any of the money? No. Why are you doing that? You are missing the boat. When you trade options, you get paid right away. The cash goes in your brokerage account right then and there. You don't have to wait for the stock to go anywhere. You can make money when it goes up. You can make money when it goes down. You can make money when it stays sideways. And you can make money every single week like clockwork. You see this view? How do you think I pay for this? Options trading. Anyway, today is Sunday, and I'm going to show you a bunch of amazing trades that you can do Monday morning. Watch this video. I'm going to go through tickers that aren't that expensive. So if you have a small account, you don't have to worry. You can still make money. And before I jump right in, do me a favor. You see that little subscribe box on the bottom right? Click that subscribe button. I'm putting up a video every single day for 1,000 days. I'm talking all about different trades. If you want to see a specific ticker, let me know. I'm going to do this video right now on a few different tickers that people ask me for. And I'm going to walk through all the trades using my live platform. I'm going to show you exactly how to do it step by step. Let's jump right in. First, I'm going to start with SOFI. So many of you guys are talking about SOFI. It's been super hot lately, trending way up like you can see in this chart. So here's my trading platform. This is Thinkorswim. And this is a 52-week chart. So first, you're always going to take a look at the stock and see where it's been for the past year. So you can see that SOFI has been on this uptrend. Now let's take a look. It closed at 29.68 on Friday. I'm going to start with a 1-week option. Those of you guys who have watched my content know that I really focus on weekly contracts. Why? 2 reasons. Number 1, I don't want to tie up my capital for an extended period of time. Number 2, I want to make money every single week. I want to put cash in my pocket on a consistent weekly basis. This is how. Now, strikes are down the middle and puts are on the right-hand side, right? And here's the great thing about selling a put. You get to choose what price you want to buy the stock at. So you can choose a $29.50 put, a $29 put, a $28.50 put, a $28 put, etc. You get the idea, right? You're going to look at this column here. This is the delta column, right? The delta just tells you the statistical likelihood that the stock is going to go from where it's trading all the way down to the strike price before the contract expires. In this case, we're looking at November 7th. So let's take a look at something that's pretty conservative. Let's look at a 28 strike price. What that means is you're committing to buy 100 shares, but only if the stock drops below $28 before the contract expires on November 7th. This contract last traded at $41. So $41 gets dropped into your bank account right then and there, and you keep that no matter what. If the stock goes up, you keep that money. If the stock goes down, you keep that money. If the stock stays the same, you keep that money. It doesn't matter. Now, before you make a trade, you always want to calculate the rate of return, and you want to understand how much money do you need to make that trade. Well, guess what? If we're looking at a $28 strike price, that means you're committing to buy 100 shares at $28, so you need $2,800 in your account. And because this contract last traded at $41, we're going to calculate our rate of return like this. 41 divided by 2,800 equals almost 1.5%. Here's what that means, guys. You are making 1.5% on your money, but only for 1 week. If you did a trade like this every single week, how much money are you making every year? You're making 76% on your money. Why are you trading stocks? Why do you have your money invested in mutual funds? If that's you, I'm telling you, you're missing the boat. You have to look at trading options. Let's say you really super like SOFI, right? And you want to be a little bit more aggressive. Well, guess what? Instead of trading a 28 put, trade a 29 put. That last traded at $72. Let's calculate that rate of return. $72 divided by 2,900. Now you're making almost 2.5% for 1 week of time. Oh my gosh, if you did a trade like this every week, you're literally making 129% on your money. Do you see how easy this is, guys? And here's the worst case scenario. SOFI drops in price and you buy the shares. Well, guess what? You like the stock anyway, and you're buying the shares on sale. And then the following Monday, you turn right around and sell a covered call against those shares and make money again. Like, why is everybody not trading options? I just don't understand it. Okay, let's take a look at another stock. This is HIMS, H-I-M-S. Somebody else on my YouTube channel asked me to walk through a trade for this. And you'll see it's kind of up a lot, down a lot, up a lot. You know, it's very, very volatile. But that's okay, because volatility is your friend when you trade options. When you trade a volatile stock and you're selling a put, let me walk through an example. You sell a put and the price goes down and you buy the shares. Because it's volatile, it's very likely it will bounce back up. And that gives you an opportunity to sell covered calls against those shares and make money when it dips down and when it bounces up. So let's take a look at the options pricing for this as well. So again, strikes are down the middle and then puts are on the right-hand side. So HIMS last traded at $45.46. Let's say I wanted to sell a $43 put, right? If I look at the delta, it's 32, meaning that it's approximately 32% likelihood that the price of HIMS is going to drop from $45.46 below $43 before the expiration on November 7th. Now, this volatility is super high. And the volatility is super high because they're about to declare their earnings. So let's calculate the rate of return here. If I was to sell a $43 put, that last traded at $207. So that means $207 is going to be dropped into your account, and you're committing to buy 100 shares, but only if it drops below 43 before November 7th. Again, if it doesn't go down, you don't buy the shares, but you keep the $207 either way. Is that a good deal? Let's take a look. $207 divided by $4,300, which is our capital that we have to commit if we're not using margin. I'm just showing you a cash secured put. That gives you a rate of return of almost 5%. Remember, guys, that's for 1 week. If you did this weekly, you're making 250% on your money. Now, let me show you a bonus here. You can actually use margin if you wanted to. The easiest way to check to see how much the margin requirement is this. I'm going to click on the bid, and it brings up this order entry box. I'm selling one HIMS November 7th, $43 put. I'm going to right click that and I'm going to analyze the trade. And this shows us the margin requirement on this particular trade is only $1,212. What does that mean? That means this. You need $1,212 in your account to make that trade. Now you do need a little bit more of a buffer because if it goes down, you don't want a margin call. I have lots of other videos that talk about margin, but what I'm trying to illustrate here is how much money you would need to make the trade if you use margin and what your rate of return would be. So check it out. So if we're making $207 and we're putting up $1,212, we are literally making 17% for the week, guys. Oh my gosh, how much, if I made a trade like this every week, how much return am I making on a yearly basis? I'm flipping my money almost 9 times. You guys see the crazy power of options? Now here's another idea for HIMS because they are about to declare earnings. Let's say you really like this stock. You can buy 100 shares right when the market opens. It last traded at $45.46. So you buy 100 shares, you spend $4,500, and then you sell a covered call against it right away. So in this case, what I would do is I would sell a $45.50 covered call because that's right over the price at which you own the stock. It's not about making money on the stock. It's about taking in guaranteed streams of income via option selling. So this contract last traded at $355. Here's what this means, guys. You buy 100 shares at $45.46. Your capital outlay is about $4,500, $4,600. We'll round it up, right? Then you sell a covered call against it right above what you paid for the shares. You take in $355 right away. What's our rate of return? $355 divided by $4,546. That's if you're not using margin. You are literally making almost 8% on your money in 1 week. Oh my gosh. You can do this trade and you can couple it with a short put. So here's what I mean by that. You can buy 100 shares, sell a covered call, and you can also at the same time sell a put that's kind of far away. That way, if the stock does go down, you have the 100 shares at that higher figure, and then you might have to buy the 100 shares at the lower figure, so you're averaging down your costs. And then sell a $40 put. That last traded at $105. Let's see the rate of return for that. 105 divided by 4,000, because that's how much capital you need to make the trade if you're not using margin. So you're making 2.5% on your money again for 1 week. Oh my gosh, you're making triple-digit returns on your money. Can you guys see yourself doing this? This is not hard. I'm planning an upcoming free live event, and I'm gonna go through all this step by step. This is a quick video, so there's only so much I can show you in just like 5 or 10 minutes, but I'm gonna have this event coming up that's gonna be 2 or 3 hours. I'm gonna put the details in the comment section below, so be sure to register before all the seats are gone. Okay, I wanna show you another one, LUMN, L-U-M-N. This is another ticker that someone on my YouTube channel asked me to take a look at, and it's only $10 per share. You see the last price, it traded at $10.28 per share. Let's take a look at the chart. Oh my gosh, so it went down a lot at the beginning of the year, and then it's been steadily going up. And look at yesterday, oh my gosh, like this stock has a lot of volatility, but again, don't be afraid of volatility. Volatility gives you higher amounts of premium, and it gives you the opportunity that it goes up a lot and down a lot pretty often. So if it goes down and you buy the shares, it gives you a lot of opportunity to sell covered calls against it and make money on both sides, whether it goes up or whether it goes down. Let's take a look and see what this is trading at. Okay, we're gonna look again at a November 7th contract, and let's look at a put. Okay, so LUMN last traded at $10.28. And let's see if we sold a $10 put, that last traded at $41. Let's take a look at what the rate of return is. This has high volatility. Look at over 100% volatility. We're gonna divide $41 divided by $1,000 because it's $10 per share. We're making 4% on our money, but again, that's for 1 week. If we did a trade like this every week, we're making 213% on our money. Let's go a little further out. Let's do let's say a $9.50 put. That means it has to drop a little bit more in order for us to have to buy the shares. That last traded at $23. $23 divided by $950 is very, very low cost to trade. You're making almost 2.5% on your money, but again, that's for 1 week. You're making over 100% on your money. Oh my gosh, why are you guys selling stock? Why are you guys rolling contracts? Listen, it's not about being in love with a stock. It's not about like holding onto shares and hoping and praying that that goes up. It's about creating cash from stocks. It's about creating a consistent, steady stream of income for yourself that you can use as either a side gig or you can actually live on. I live on my income. You can do the same thing. Anyway, I hope these ideas help. You can definitely use these for Monday morning. If you want more help, subscribe to my channel. I'm putting up a video every single day for 1,000 days. I'm about to start a podcast soon. I'm gonna host a live event in a couple of weeks. I'm gonna put the details in the comment section below. It's gonna be totally free. I'm gonna walk through step by step how to choose the stock, how to choose the strike price, how to choose the expiration date, what does it mean selling puts, what does it mean selling covered calls, how do you protect yourself from losing money, how do you manage the trade once it's on there. Thanks for watching. Happy trading.